Perfect.
Okay, hold on a second. Yes, so we are ready now. Bruce?
Well, there's a few things I thought we'd accomplish tonight. One, this was sort of inspired by a desire to do some review and create an environment where we could have questions asked and answered regarding aspects of Wyckoff to end our FI354 semester. So, and we thought it'd be terrific to invite other Wyckoff students to join to the capacity that we have available in GoToMeeting. And so so really this is somewhat of an informal presentation, and it's an opportunity for people to sort of ask questions or talk about things that they've been thinking about regarding Wyckoff. And also we have an opportunity maybe to go through some case studies, a few case studies in the course of the hour that we're going to be going. And so that's what was the primary goal for tonight. And Ramon, any comments?
Well, I just kind of like put this quick slide for the agenda, and we thought that what would be great, because this is the end of the class, is to talk about maybe what I would call a problematic areas for students, something that something consistently comes up as a question to us. And we have 3 questions that are very, very common questions that I would like Bruce, for us to discuss with you, and then we can go into the case study of Netflix, and after that there will be a general Q&A session.
Sounds like a great hour. This is like prime time. This is better than prime time television.
So and I know that yes, and I know that both you and I, we love having those conversations. So
yeah, this was the part that was really fun. Was you know, Roman, we don't get that many opportunities to really sort of put our heads together and work on what we love, which is to discuss Wyckoff, and you know, Roman's working hard, teaching and doing other, you know, really important jobs at GGU. And
let's just be frank, Bruce, here. The conferences are taking time from us. You know,
yes,
we shouldn't be doing any conferences anymore.
Let's not let that happen again.
Let's not, at least for the next 15 years. Yes.
Yeah, okay.
Yes, all right. Great.
Okay, so let's move on here and
all right, so the first question, Bruce, that I would like to ask you, and I'm bringing here a historical example of Apple on the daily chart in 2002-2003. And the first question that is a very common question is that from a student, how would you suggest to improve my Wyckoff labeling of trading range structures? So our students sometimes have difficulties of identifying specific phases or specific Wyckoff points. And you and I, of course, we've had those conversations before. You know, me as a student before 15 years ago, and now teaching this material, you know, what are the best teaching practices that we can give to our students? And another question which is related to this is, once the students understand the Wyckoff points or the phases, or even the volume signature analysis for those phases, the next question that I receive a lot is about historical labeling versus the real-time labeling. So that next step, next level of mastery in your labeling, how do you actually go there, and what do you do? So Bruce, would you like to start addressing those questions?
Well, so much of Wyckoff is really about being able to function in real time. And when we go through a real-time chart analysis, you know, I like to actually think that when we look at historical charts, that the historical charts are really not telling us the whole story, because in those historical charts we cannot recreate the news flow. We can't recreate the emotional tug of war that's going on inside of us in terms of, is this the right place? Is this the proper action? Is this am I reading this correctly, etc. And so this is one of the great paradoxes of being able to do chart analysis as a trader versus doing chart analysis as an analyst. And
what's the difference, by the way? How would the analyst, let's say, do the analysis differently than a trader?
Well, an analyst is maybe I believe an analyst has the opportunity to be a little bit more detached, and that they are able to look at conditions absent of putting on a trade which has a significant relevance to a person's net worth, potentially positive or negative. And an analyst is going to try to create advice that is going to be helpful to their client at the level that their client needs it. And so, for instance, it might be overweighting an industry group, or it might be overweighting or underweighting, or it might be where a trend changes. It could be any number of things, but there's a level of detachment that actually can allow an analyst maybe to become a very good analyst, because they're able to focus on the proper points where their client will take action. In Wyckoff, Wyckoff is a tricky method in the regard that Wyckoff analysis and labeling and sort of the unfolding price volume characteristics, Wyckoff is trying to put us right on the cutting edge, right on the bleeding edge of these trading structures, where best trading positions are taken. And so we can look at this chart that we can see here.
Yes, let's go to this chart. And well, when you look at the chart, how would you label it? I mean, what would you start with? And I guess this is the first exercise that we give to the students. We don't give them the real life examples, real time examples right away, right? So we want to develop that pattern recognition to identify the Wyckoff phases and Wyckoff structure on the historical chart. So how would you, what would you advise to the student when, let's say, we look at this chart? What would you look at?
A big part of the genius of Wyckoff is in establishing the trading ranges, and trading ranges in a trend are trend channels. Trading ranges in accumulation phases, as we're looking at here, are horizontal trends, so to speak, where there's no movement one way or the other. But they're structured in such a way, Wyckoff would have the narrative that the purpose of an accumulation range is for the CO to be able to accumulate as much stock as possible in a way that they don't move the price out of the trading range. And so they're trying to accumulate significant positions in these shares and do it so that they don't move the stock. And in this case, in this example, you can see that basically we have where one has been labeled, we have something akin to climactic action, which we could label, say, preliminary support, where it could actually be considered the climax because of all the volume. Now, after that, there's a short, sharp rally, which has the attributes of an automatic rally, and all that an automatic rally is, and this is something that's really important. we may see multiple climaxes in the course of a distribution, a markdown phase, and each one of those climactic actions on the way down, we may see 3 climaxes on the way down. Well, all of them have similar characteristics. They all have a similar purpose. And it's not uncommon to see 2 or 3 big climactic drops.
Mm-hmm.
And so
that would be, and why would that happen, Bruce? I mean, what would be the function to have those different climaxes at different levels?
Well, there's a tremendous amount of overhanging supply of stock that needs to be released by the public, and it's not only the public, but there are a lot of institutions out there that trade like they're public. And so there's a lot of stock that needs to be released, and my view is that the climax is not, unless you're really good at this, the climax is not the place for a Wyckoff to be acting, but you want to pay very close attention to them, because as climaxes are occurring, this is telling you, especially the acceleration into these climactic conditions with huge volume, this is stopping action. And so even though there may be 2 or 3 of them, what you're seeing is that you're seeing that there's demand, significant demand coming in on these accelerating price lows, where there are certain types of there's certain types of COs or certain characteristics of a CO where they're willing to buy stock at these prices. And so that high volume is telling you that there is demand coming in and absorbing that stock at those prices.
I think it's a very important point for the students to recognize, and we kind of jumping into the supply and demand block of knowledge right now, but what you just said, this volume spikes on the way down, it's not just supply, it's also a presence of demand, because even though the price is still going down and supply is still evident, somewhere on the way down, as you put it so eloquently before, there are the first signs of intelligent accumulation, and the preliminary support, the rally of the lows, is that first evidence of that first intelligent buying by big interests.
And only large informed interests can command the type of volume that is showing up where you've highlighted those big volume bars.
And we've discussed this before with students. The question that I always ask them is, well, why is it so favorable to the big interest to buy on the selling climaxes?
It's because that is where there's meaningful supply available to be bought.
Exactly. So if we are talking about big composite operators, who are those? Those are big pension funds, insurance companies, some of the significant big hedge funds, mutual funds. So it's their capacity to actually establish a big position. It's not going to come at the end of the trading range and in the uptrend. Because if they're going to start buying here, they're going to significantly move the price away from the trading range.
There is a large informed interest that is buying there, and they're buying late. And so it's almost like you're looking at the food chain, and it's like the food chain in the ocean. And so you're seeing that there's different members of the food chain that are participating along the way. And these are all, it's like thinking of everybody that's acting inside the base are like the apex predators. All the accumulators, and all through that base, even though they're going to be different COs at different times in the base, they're all apex predators in the regard that they have a strategy for how they're going to accumulate shares through that whole accumulation phase.
Okay.
And so, but they're different apex predators. The apex predator that's at the preliminary support and the climax are going to be different than the ones that are going to show up in, say, the late in the B phase and the C phase and so on. So just to move on here, the first thing you want to do is draw the outward boundaries of the horizontal trading range, which is going to be the top of that first rally after the preliminary support.
Right here.
Draw the horizontal line across there. Yeah, perfect. And then you're going to want to draw that line across you can draw a line at the preliminary support, definitely. And then you'll want to draw the line where number 2 is, because that actually is followed by the first an important rally off of the low. And so you can see that there's much of the trading range is contained subsequently. I mean, think about how important this is. What you've just done with no more information than where the preliminary support, the rally, the automatic rally afterwards, the climax, we'll call it a climax, into number 2, however you label it, however you decide to label it, you might label it a climax, you might call it a secondary test, and so on. However you label it, if you're really clear about what's going on there, you're not going to be knocked off your analysis. So now, look at the fact where you drew number 2, from number 2 across on that horizontal. Look at how well it contained the bottom of that trading range. There's an old saying, first they shake them out, then they tire them out. And so the first thing that happens is with series of climaxes, they shake out all of the week's stock holdings they can, and the ones that tenaciously hang on, they then wear them out through the remaining of the trading range over the course to number 10 by making the stock dull and quiet, and look at how they have it trading in the bottom part of the trading range. Now, not all stocks do that, but it's not uncommon to see this. And so in this case, you have a very wide trading band, but what Wyckoff wanted was to focus on where demand comes in to a stock and where supply comes into a stock on a trading range. We can see demand showing up at 2, at 7, at 10, number 6 there, and number 8. The demand is coming in at those levels, and those are the places where people loathe to buy shares. They just don't want to buy shares down there. And the demand, or that's where demand is. So where the supply is across those prior peaks. And what they called that was a creek. And a creek is a meandering sort of a line that follows across the tops of these rally points. And so that is where demand shows up around the lows. They rally it. They rally it up to these levels of supply, which is what the creeks are. And you have, in this case, you can see that there's a creek that runs across the lower level, not uncommon. Then you have an upper creek. And the upper creek is sort of where that upper horizontal line is. And so this is where the art of it is, because what Wyckoff wanted Wyckoffians to do was to see where the demand was showing up and then look for those demand points as places to put a trade on. Now, what Wyckoff wanted is he wanted for his students to be at these points which were the places where the terminal structure of the trading range was going to change the characteristic, and that's at this number 10, where he would, and I call that the cathartic moment. And the cathartic moment in this case is what's referred to as a spring.
Okay. Well, I'm going to put here the Wyckoff buy zone because we're looking at the accumulation, and officially that's kind of like the name for this zone. This is where we want to establish our position. But Bruce is talking about the spring at point number 10. Okay, go ahead, Bruce.
So one reason that you would expect a spring that takes out the entire low of the trading range is because of the way that the stock is staying so close to the bottom of the trading range. They don't all look like this. Mm-hmm. But when you see something like this where it just stays compressed near the bottom of the range, the one thing that you notice in the volume signature is that the volume tends to dry up as the stock is being pushed back down to the bottom of the range around $7. And so all of these, and you see a lot of overlapping bars. You see a resistance to moving down. That's all what was referred to as absorption. And so you have absorption of supply down in these lower levels, and these are the things that we as Wyckoffians develop an eye for. Mm-hmm. But we also have to expect that when you have a stock trading so close to the bottom of the range and is literally being held down there, that's where the supply is coming in. And it very well could be that the composite operator is literally checking the advance at what's around $7.50. They may actually be putting stock on the market. That would be the narrative of the old days, was that they would literally check the advance. And so there was stock being sold around $7.50, and we know that because it couldn't go beyond that level. And then down it goes again, and then one last time. And this is the part where we can get our labeling right. And there's some little secrets that we can tell in Wyckoff, and that is that when you have that final push down, notice the characteristic of the push down in the spring and how it's different from the pushes to the low in the prior when it reaches that demand point at $7. Notice the difference, and you're going to develop an eye for this, is that it's almost like a little climax. Mm-hmm. And there's a whoosh down, and that whoosh down with a big bar on big volume, which is being perceived by the marketplace as, oh no, this stock is starting its new leg down. Mm-hmm. And there's no we as Wyckoffians can say, let it go. This might be a big old shakeout. This thing may go down to $6, $5.50. It may go way down here. But what we do is, as soon as we see the price stalling after that big bar down, and we get a higher low, which is a secondary test of that spring, we just play the probabilities, and we say, I'm going to put on some part of my whole tranche. It might be a quarter, might be a third, who knows, but like whatever you would allow, whatever your position sizing is in your portfolio, and who knows what your each one of you is going to be different, but you might say, I'm going to put a third of my total position on in this stock on the test of the spring. This is just the place you do it. This is where the probabilities are best, and what I need to see, you know right where to put your stop, because your stop goes below the low that was struck before the test, and Ramon has drawn a line there. So your stop goes below that, and then immediately what you want to see is the stock price to climb back into the trading range and start to work its way up. And what we expect in Wyckoff analysis is that this is when the stock's going to get busy and is going to run to the top of the trading range. It may take a number of weeks, may take a number of days, but we're expecting to see a change in behavior. That's why I call it the cathartic moment, because we're expecting a change in behavior, because if they can't take it down to new lows and hold it there, that means that this stock is all in strong hands. It's been absorbed by large informed interests. It's in strong hands, and they're going to expect much higher prices before they sell any of those shares.
All right. Well, great. So what I'm hearing from you, Bruce, is that first you talked about the downtrend, in this case, coming to a stop in action, having climactic action, observing the first signs of intelligent buying, those rallies that are bigger than any of the rallies previous in the downtrend, and then having that selling climax, which could take different forms and different volume signatures, but the main idea there is that the supply has to decrease, the supply has to be tested. And then, yes, and then going through the trading range, the next interesting point for us as Wyckoffans is phase C. So I'm going to put here the borders here for phase C. And it's the final retest of all of the previous points of supply and demand on the chart. And what it does, if it's truly a sprint, it will lead us to the very visible action, which we will call, which Wyckoff calls the sign of strength. And that action has specific characteristics. And also, this movement through the trading range from the support area, from phase C, above the resistance cluster, it also has its own test in the backup to the creek, or the LPS, which is the last point of support. So those are the things that students have to pay attention to when they label. Correct?
Yeah, exactly. And the notion here is that when we see C-phase type testing action, that we think is the testing action that's going to end the price being in the lower end of the trading range. We look for testing type characteristics. You can see those little red bars where there's no progress made to the downside after that low is made, like 4 bars later, and you can see how low that volume is as the stock just holds at that level, which is the level of the prior lows where demand is met. And demand shows up.
Look at this.
And then all of a sudden it starts to go. And here's the thing, what you're going to develop a skill for was recognizing that when you get the C-phase testing and you start to see strength that is unlike the strength that you saw prior, you're going to be willing to buy that strength. And because you know that there's something different going on. The rally after a C-phase test, the subsequent rally is such that strength is going to, you're going to develop such good skills at seeing that and being prepared to trade that you're going to be able to buy the strength there where you weren't willing to buy the strength before that. And that's where you're becoming a Wyckoff master. And so the C phase is just such high art, but there's a lot of little things that we can do to be able to help us. Footnote here is that when you're in the C phase, a lot of times that final test is not going to come at the lows like it did here. It's going to come in the trading range.
At the higher lows.
And when you're in the trading range and you get that last testing action, it's trickier. And so it's actually more difficult to navigate, but it's very possible to navigate that correctly.
Okay. Well, I'm going to erase all of this right now, and just to conclude our discussion here on the Wyckoff labeling, I want to really quickly show.
Let me just say something, because we are talking about this idea of labeling.
Sure.
Is that when you're in a B phase, and we know that a B phase is just this willy-nilly trading action that tends to be volatile. There's wide swinging movements up and down. You can see a B phase, a classic example of a B phase is in October, where it rallied up to $8.50 and met supply at $8.50. And then that looks that's enticing. Somebody bought that. People were buying that. And then inexplicably, unexpectedly, and this is classic B phase behavior, all of a sudden out of the blue comes these big wide red bars, and here it goes on its way back down to the lows again. When you're in a B phase, you have to expect a lot of that type of behavior. We tend to avoid trading B phases because of that very behavior. And so our ability to be able to see the distinctions between a C phase test and B phase action is really important, because people lose money in B phases. And we prefer not to trade those. And the only way you trade those is if you're a CO and you're accumulating the bottom of the trading range. So anyway, I just want to say that about labeling and trading range structures, is that when you're in a B phase and you get the top of that range, expect it to go back to the bottom. Just expect it.
All right. Thank you, Bruce. So just to summarize and really, really quickly go through some of the helping tools for you guys to put in your arsenal. And we've discussed those in Wyckoff classes and in the advanced Wyckoff class. When you look at when you're given a historical chart and you look at the historical consolidation, I always ask students to identify something that catches their eye. So when you look at this chart, ask yourself a question: what is so unusual about this chart? What catches my eye? So for me personally, I want to identify phase C and D and A right away. Those are going to be one of the easiest phases to identify. So as Bruce was saying, we see that there is a trading range, and I'm going to label it a little bit differently. So this is going to be my levels here, and then the level here from phase B. So I see that there is a penetration of the price to the downside, and which is lower than any of the support levels. So most likely this is my phase C, because that's the final retest. Another indication that this is phase C is that the price after this is traveling up through the trading range and then out of the trading range. So that's definitely a characteristic and principle behind phase C. I know that after phase C I should experience a sign of strength, and sign of strength is going to be a rally with the specific volume and spread characteristics. And I want to see that rally to overcome any of the resistance clusters that were created in phases A and B. And it does. And look at this commitment right here. And then I want to see this retest in phase D of the previous resistance, now support. And here is your test right here. It's a backup to the creek. So you instantly see phase D. So everything above that is going to be your phase E. Now the next step is to identify phase A. Phase A, as Bruce was telling us, is a stop in action. That's the intention behind phase A. So I want to see where those stop in actions actually show me the potential beginning of the end of the downtrend. And I see that there was first attempt and it failed, so I would label it as a preliminary support here, and then a series of down bars here, still on the volume spike. I would say that this is a selling climax, automatic rally, which will define the first resistance, selling climax defining the support, local secondary test, and that's my phase A, where I have that stop in action. Now I have phase C and A identified. Anything in between is B. So this is one of the most practical ways to quickly go through the labeling of the historical chart. So look for something that is catching your eye right away and work on the principles, Wyckoffian principles, as to what is phase C, what's the intention behind phase C, what is phase D, what elements, Wyckoff elements we have in phase D, and identify those. Go to phase A. Everything in between is going to be B. And you might not identify each point here, but that's not the point, because Bruce was telling that we don't need to trade phase B unless we are really, really short-term traders, and we are really good in trading those short-term swings, but we wouldn't advise to trade that. Now, Bruce, really quickly, I'm just going to probably start, and please feel free to add here. This last point, the historical versus real-time labeling. To me, the best exercise was always to cover what's coming up next, and then just to practice identifying the phases and Wyckoff points that way, because that's what develops the skill of pattern recognition in the trading range. Would you agree?
Yeah, I think that's a great idea. And then the other thing I would add to that is actually put, as you're unfolding and you see your junctures where you would trade, is literally trade that, and I mean, try to put real skin in the game.
Exactly.
In the regard that, you know, you make it consequential to yourself to make a good trade there.
I totally agree. So let's just quickly do this. So let's say that I cannot put anything here to cover the whole chart, but let's assume that we don't see what's coming next. So as I'm going through these notions here, let's say that I thought that this was a selling climax, and then we have this rally, and it looked like automatic rally, and we can assume that, and we can start, you know, putting off the boundaries. As the price goes lower, I can assume that we have the new boundaries here for the support and resistance. And this is a selling climax, automatic rally, secondary test, my first phase A. And now I know that in phase B, we might have that upthrust action where the price goes up, commits, and then fails. And I know that in phase B, somewhere I have to retest the previous lows, the lows in phase A of the selling climax and local secondary test. So here is this test coming in, and we can label it as a secondary test in phase B, and we know that most likely we're going to retest those lows again. And the retest comes, and it actually, the price commits below the support really quickly and then goes up. So here, as a Wyckoffian trader, I might assume that I'm potentially experiencing a spring. I want to check the volume signature, and I'm looking at the volume here, volume here. So the volume is actually contracting here, which is a good sign for the spring. And if I'm a trader, I know the rule that I'm not buying this spring unless it's spring number 3. I'm buying the spring always on the test. So I want to have a higher low, and the volume should contract, and the spread of that test should contract. Now we see here that this spread is quite large. And then when we look at the volume signature, supply actually increases here. So we might not take on this position on this test because we see that supply is still present. But let's assume that we made a mistake and that we've entered the position. So my entry probably going to be somewhere here as the price starts to move. And this is something that is that Wyckoff also was mentioning, but I think that Golden Gate classes, you know, in there we've developed that methodology, that trading approach. If you're wrong, the methodology allows you to get out of the position relatively quickly through your analysis or trading techniques. So let's follow this logic here. If we are entering this position on the assumption that this is the test of the spring at the higher low, and our stop loss aggressive is here, more conservative is here to your liking. We need to overcome this high, and we need to overcome this high in a specific manner. We are committing to the upside here, which is a really good news, and we are happy. But what we don't see is when we compare the price structure of the spread and the volume analysis, we don't have that big confirmation that this is a big sign of strength. So this spread is relatively the same as on the last rally to the upside. And then when this big spread to the downside comes, this is an element of supply. And combined with the potential upthrust action, this could be the first place where we get out of this position. Let's say that we haven't done so, and we made another mistake. So wait until you create a short-term support level, and if you're still thinking that potentially a backup in phase D gonna come, then you have to have a failure which comes right here to close this position, because this is the final call to you that you were wrong. You were wrong in your initial analysis, or something has changed in the stock and supply became relevant again. So that means that we are still in phase B with all this volatility, volume spikes, and big spread. So now we have to wait for the retest in phase C. And where does it come? Again, refer to the principles. Everything is in the principles. So we're taking the support cluster that was created by the selling climax and by the previous pseudo spring. So we're going to label it now as secondary test, or as a sign of weakness. We have the price that undercut the support, and the volume has increased here. So that's a sign of weakness that tells us that even though the price might travel, we still might consolidate. We still might go down from this point, and the price does exactly that. So by defining the support level here, we want to wait for the price to drop into this area, and it does it in this area right here. So here what we need to do, again, buying the spring, if we're assuming that this is a true phase C with the spring, we need the test. The test should come at the high low with the contracting volume. Where's the first time when we see this high low? It's right here. And these are the two declining bars. What is the volume here? It's definitely much lower than the volume going into the actual spring. So as Bruce was saying, this is the high probability place for us, to open the position. And you can use different techniques here, how you're going to open. You can look at this as a small trading range and dissect it by Wyckoff principles, or you can just trade a simple breakout methodology. Wyckoff usually would look at the smaller spread, smaller decrease in volume, and that would be the point of entry. And so that would be the real-time labeling and real-time trading combined, when you already know all of the Wyckoff points, Wyckoff phases, how to do this analysis. And it's okay to make a mistake. Not right away you're going to see those smaller distinctions in this area of why this is not a spring, or this is not a test of the spring, or it's just failing even though the price is going down, but there is no strength behind it. There is instant reversal on the supply presence, and so on and so forth. That will come with the time. But Wyckoff methodology gives you an opportunity, even with mistakes, to get out and to have either a smaller loss, break-even trade, or even a slight profit. So, Bruce, anything to add here?
That's why I love doing these with you. That was great. And
I hope we're bringing the practical part of not just the analysis, but those trading techniques.
It's all good. Yeah. That was very good.
All right, sounds great. So let's go to the next one. It's still a structural question, and this is a very common, Bruce. I'm sure that students have asked you so many times. How do I know if the current trading range, current consolidation, is reaccumulation or distribution?
Well,
And I have two charts here, by the way, Bruce. So these are the stepping stone from accumulation here. And then the second one is the same chart with the same stepping stones. And then you have this distribution pattern right here. So just let me know which one would you like to use.
Well, the first thing, just staying with that one for a sec, is that with a stepping stone, the first thing is how much fuel do we have in the base count, which we get from a point and figure count. And so we would take that, and this is what we're going to do in the second semester class, is we're going to focus on the art of horizontal point and figure counting, which is hugely important. And so we'll come back, we'll talk a little bit more about that at the end. But so the first thing is base count. Then as you go up into your stepping stones, you are, in this case, what Ramon is showing is that you're going into a series of stepping stones long before you fulfill the base count. And so those are reaccumulations which can be counted, and often those reaccumulation phases will count up into the vicinity of the final large base count price objective, which is what Ramon is drawing there. And so that in of itself is a clue that you're not done. The uptrend is not over. Now, going back to that other slide, for the sake of time here, is here's some basic rules of thumb regarding reaccumulations. Is that a reaccumulation, when it starts in the same manner as distribution, meaning that you climax the move. And you can see in those schematics, you can see that those stepping stones are begun with a buying climax.
And this is not the final buying climax, right, Bruce? So just to clarify, it's the intermediate buying climax. But it does stop the price from moving at least for some time.
Yes. And so this is an important concept that is going to show up over and over again in your chart analysis, is that most, I'd say almost all important moves in a trend, when they're stopped, say for reaccumulation or for distribution, are going to be climaxed. And so what that says is that you have an overabundance of optimism among the investing public and among the institutions that needs to be consolidated, and there needs to be a period of stock being distributed or sold as profit takers will take their profits, and in institutions or the CO is looking to accumulate more shares. So climaxing the stock is the way this is done. That climax will set, as you see in these examples, the top of the trading range. Right after you set the buying climax, usually within a short period of time, you have a sharp reversal of price, which is like an automatic reaction, which sets the bottom of the trading range. And then for the remainder of the time, you're trading somewhere around the edges and within those outer boundaries. And those boundaries, just to reinforce this point, are usually set right at the beginning of the climax. Now, all three of these examples here in the same stock are really somewhat different. And so what happens in reaccumulations, and many people are tricked. They think that a reaccumulation is actually distribution, and they attempt to short the stock. And
so why does that happen, Bruce? So because of the variations of the reaccumulation trading ranges, they think that this is a distribution?
It's actually the patterns that show up in reaccumulations are the patterns that are common to distribution. Double tops, head and shoulders tops,
Mm-hmm.
and so on. And I call those, I have a term, there's an old B movie that I thought was pretty cool called Mimic. And you don't have to see the movie, it's not a great movie. But I love the idea of it in the regard that it's about how you mimic something. And so wouldn't you expect the composite operator to mimic distribution when they're reaccumulating shares for another big move up?
Absolutely. And I think we also should consider that there could be some distribution in the consolidation which ultimately will be reaccumulation range, and that supply could be just absorbed at some point because like we have today with Netflix, and we discussed this with you, you know, Carl Icahn, right? Am I pronouncing his last name correctly? So he sold only half of his position. So he still expects the price either to go up, or he's looking for the opportunity to sell the other half. But composite operators, those big operators, they can sell into the rally, and the buying climax and this first reaction is the evidence that there is some selling by big interest.
All reaccumulations are a period of overarching supply that need time to be absorbed for a further move up. Now the art here is, it just for the sake of time, the art here is to recognize that when you get about a third to halfway through a reaccumulation, and of course we don't know how long they're going to go, but let's say you get 12 weeks in, and you'll often make your low in the first third to half of the time of the reaccumulation. And then what tends to happen is that volume tends to dry up on the reactions and even on the rallies. The volume tends to diminish throughout the remainder of the range of a reaccumulation.
So what in effect you're talking about is the absorption of the supply.
Exactly.
So if the structure, excuse me, if the structure is going to be the same in the sense that the structure for the distribution or accumulation are somewhat the same, especially at the beginning of the consolidation, you are looking actively for the absorption of the supply, because it's only when supply is absorbed the price is ready to move out, whether there is an overwhelming demand for the stock or just a small demand.
Correct. And that is the difference between reaccumulation and distribution. When you get into the second half of distribution, volatility really becomes greater and volume expands, and especially it expands on the declines. So volume will shrink on the rallies, and it'll become larger and larger on the declines to the bottom of the trading range. And so there's a very distinct, you could almost say that the first half of reaccumulation and the first half of distribution almost look the same. But the second half, they deviate tremendously. And you start to see huge volume coming in as you complete distribution, and volatility increases, especially on the down moves.
Well, let's look at this example. So here we have the same chart. We have our regional accumulation range, and then we have quite a few stepping stone trading ranges here. And then we have a top information right here. I think what you were talking about is the volatility, the presence of supply. And we clearly see from this structure right here that that volume, that supply, starts to come in really aggressively at this point. And one of the things that we've developed in the advanced Wyckoff course is the definition of the consistency of such supply. It's not only that we're looking for the volume spikes on the supply. we also want to find the places where there is a wave of selling. And we can see that in this phase D right here, we have a consistency of selling in this area. If we would compare this consistency of volume that is appearing and the price is going down with the previous down moves and consolidations, we would have to go back and look, compare, and it's only here where it was heavily distributed we see something similar in the consistency of that. And also another point that I want to make, and that Bruce, please add to this. What I see as a mistake, as a common mistake for students looking at the volume, is that they constantly look at the volume, but they don't look at what the price does. So this lore about the effort versus result is being neglected. So I would love to see more of students, paying attention on this volume, what is happening with the price, and compare that to the previous trading ranges as well. And this is how you will gain the understanding of the differences between the reaccumulation and the distribution. Look at the move before the final move to the upside here in the stepping stone. Lower volume, and then the price is not traveling as much as it travels here. Compare this. And then the same here. It does undercut the support, but it's not as aggressive. And
it took a long time for it to get from
exactly,
the high to the low.
Yeah. So this idea about looking not only at the volume, but what does it do to the price? You always have to look at the result of the effort by the volume. And this is something that I see consistently is being missed. Anything else here?
Are you, just to ask a question, are we okay with going a little bit longer?
I think that we are okay, and if people feel like they have...
If anybody's got to go, we won't mark you down. But,
lower the grade. Well, I'm recording this session, so for somebody who needs to leave, and I know that quite a few of you on the East Coast, please feel free, and I'll make sure that I'll deliver the recording.
We'll go a little longer and answer questions and so on. But I have just a comment here regarding distribution, is that the one thing you'll notice is that distribution, especially looking into the peaks here on Apple, is that these stocks are being distributed on the way up, and so you'll have this CO type action where there's selling that's occurring as prices are rising, and you can see by the thrusts, you can see that there's a very nice thrust at the beginning of 2012, first quarter, or I guess that would be second quarter. No, that is first quarter. And then the next thrust,
it does look like a climactic thrust, right? Because it's so quick.
Yes, they're all very climactic. And then you have another thrust, which you look at the volume that comes in on the break of that first thrust. That's a very important clue that there's active sellers there. And then it dries up, and then it has another run up, and that's a pretty good rally. But when you look at the thrust above the prior high, you can see that the thrusts are diminishing, and then all of a sudden you have this big sign of weakness that comes in. Well, these stocks are being distributed on the way up, and then what's happening is that they go down. They're setting up the right side of the distribution, but they're almost kind of muted. So you have this little big sign of weakness, and then you have a little last point of supply, which is coming at a lower level, and the whole thing tilts down. Well, that's all going to be part of the point figure count down, and it's going to be a big count. And so this is something that's not uncommon with these stocks, is to see this kind of behavior, and you see a lot of it these days. And so I think that when we look at Netflix, maybe we can draw some conclusions there. But anyway, so I just want to make that point.
Okay.
So anyway, go ahead.
Should we? Yeah, I think
Yeah,
that we've covered this question
yeah,
nicely. And
okay.
so let's go to the next one. The next common question, and this is going to be the last question, and then we're going to go into the Netflix, is about supply and demand. So quite a few students come to me and they say, well, I'm unsuccessful applying the supply and demand analysis. What am I not doing, or what am I doing incorrectly? And I usually say, well, what are you using? I mean, what kind of analysis are you using for the supply and demand? Show it to me. And usually I understand that in the majority of cases, people are just using a very simplistic approach. So you would have the rally, you would compare the volume on the rally, and then you would have a reaction, and you would compare the volume on the reaction to the volume on the rally. So to me, this is a very simple approach which could be effective in the specific places of the trading range, but it's not enough. And this slide here, I just wanted to bring this, and I know that you guys saw this slide because I present this in the classes. Look at how many definitions of the spread and volume analysis we have here. And if you think that this is too much, look at this. This is the second slide. And look at the titles here. Increasing spread in the advancing market. And then we have decreasing spread in the advancing market. Then we have the definition of the declining market, and with the increasing and decreasing spread. And for each of these blocks, you have the increasing volume, decreasing volume, average volume. So you have these numerous variations, combinations of the volume and spread analysis of the supply and demand. Also, on the top of this, imagine that in the trading range, you're going to be presented with different phases. So the volume signature for each phase could be different and is different. So you have to multiply by the number of phases that we're going to have all these actions. So it's quite a lot of variations, and it's not as simplistic as we tend to think. What are your thoughts here, Bruce?
Oh, I wouldn't become discouraged over this in the regard that.
Oh yeah, I'm trying not to be negative.
Well, no. I'm just saying that there's a lot here, but this is just involves endless practice, and Wyckoffans love endless practice. And what happens is that you start to see these things showing up over and over again, and you start to become really clear about what you're seeing when you're seeing it. I like to say about Wyckoff, and this is the genius of it, is that Wyckoff is contextual. Other methods of chart reading are not. And so what I mean by that is simply that you have a tremendous advantage, and your advantage is that when you are saying, I'm in phase B, you know what the characteristics of price and volume are typically in phase B as it begins and as it comes to an end. You understand the context. Phase C, you understand the context. Phase D, E. And so you have this, and in uptrends, in stepping stones, in distribution, you have something that other people don't have, which lends itself to mastery. And it just requires just endless repetition, and through that you become very masterful in terms of being able to see these junctures and then being able to act on them in real time. So,
well, let's give.
This is what this is what makes you. This is what is going to make you a great trader, is understanding these contexts and understanding how volume and price dance around within those contexts.
Absolutely. Let's give one quick example here. Again, the same chart of Apple, right? And we were talking about the sign of strength. So as we were putting on the erroneous trade here in this area right here, the question that the Wyckoffian would be asking himself is, or herself, what is the action after the test of the spring that I should expect? And this is the context that Bruce was talking about. Look how in the true phase D, the sign of strength has increasing spread, the ease of movement through the trading range, and then the increasing demand. And this demand, what we know from the conventional technical analysis, this is the confirmation. This is where the demand exceeds the previous resistance cluster, commits to the upside, confirms with the volume. Now here, if you look at this break to the upside, the volume is actually on the upside. It's quite average. There is no excitement there. There is no force behind it. The spread is not increasing. And it's kind of like the same volume as before. So it's not confirming. And this is some of the mistakes come from not the full understanding of where does this confirmation has to come, at what point, in which phase, and what kind of characteristic it should have. And I see this over and over and over. And one of the things that I'm going to work with the students in November, December, it's the supply and demand. So we'll have extra sessions just devoted to that. But I definitely see a lot of that. One of the most important points is, for me personally, is this. If you would take all of the elements away on how to judge supply and demand, this is probably one that I would love to be left for me personally. I always want to know where is my supply, where is it coming, and where is it being absorbed, and is it being absorbed? And if it's being absorbed, where is my springboard? Where is that point from which the price is ready to move aggressively either through the trading range or out of the trading range? And if you can train your eye to identify that springboard or identify where supply is present and then is being absorbed, then you are winning a big battle. Bruce?
Oh, said perfectly.
I'm getting better at this.
Yeah.
All right. Okay. So now we should go to our case study.
Yeah, and we'll just, I really am, it's really maybe more of a homework assignment.
Mm-hmm.
In that I want to make a couple of just really brief points about this because
mm-hmm.
it's going to be a great case in the future for us. But Netflix, Carl Icahn announced today that he sold stock, and you can see in this chart that that I'm of the. It says that he sold half, or approximately half his position, which what was it, around 2,600,000 shares? So about 3 million shares he sold. So see, that gives you an idea how much stock these guys are moving mm-hmm. and how deftly they are doing it. And so in this case, this is a great CO kind of a story, and he says that he made a 457% increase on the sales, the shares that he sold, even though he thinks it's going to go higher. And so the only thing I would say here is that he really was in a position where he kind of needed to report this. I'm thinking of 13D filing, mm-hmm. and that even if he is in the process of selling the rest of it, he's sold half, he's reported it, he's got a big increase. They're saying that they would tend to sell or to hang on to the rest. My sense is that now there's going to be a number of people that are going to follow him, a number of other large holders mm-hmm. that are going to take the same action, which is to sell some part of their position. Mm-hmm. But he so deftly bought this that, let's say, going back to that chart, mm-hmm. that if he sold those shares in the neighborhood of around 300 to 320 in this area here, where, see, you can see a little climax in September where it was marching up, and sold maybe some on the way up. There was a climax, and then you can see that the stock generally met supply here, and then it had a throwover, which this is probably going to turn out to be what's called an upthrust after distribution, because there's either a stepping stone that's going to occur here, or maybe there's a bit of a downtrend. But let's say he sold his 3 million shares in this range here at a 457%, and he may have sold some before this, but a 457% increase means that his actual cost basis is, it says here $58. I'm not sure where that number came from, but I'm thinking that it's more in the high 60s. But if we look at this base, I want you to really, this is your homework assignment. The idea is, the rule of thumb is, in an accumulation base, that the CO is doing a good job if they are able to accumulate their shares at about the average price of the middle of the range. So you would set the high for the range and the low, and you'd sort of look at the midpoint and say, that's about where the CO is hoping to average cost their holdings in their operations. That's sort of a rule of thumb. But you can see here from what Roman drew that this is a phenomenal accumulation. And so what your job is to see to identify the footprints of the large operator, Carl Icahn, and possibly others, accumulating in the range of where accumulating in that accumulation range, and how deftly they were able to do that. And so this is just a great case study, and it shows what a master he is, in that these COs are masterful like that. Their best practices in terms of accumulating shares in these accumulation ranges is substantial, and it's a beautiful example. So I would just study and study and study that, because I think that his cost, on my sense is his cost basis, and maybe we'll learn more later, is somewhere in the neighborhood of the high 60s. And if that's true, he really did a great job. And you can see that after that, look at how this thing just started to march up and then gapped, and then had a backup, and had a backup to the edge of the creek, had another gap, and it was on its way. And all of those were opportunities to buy and add to positions. And this is what Wyckoff would want to do, is identify when strength should be bought.
Mm-hmm. By the way, quite a few students of ours, were in the stock. So it was really pleasant to hear that they were able to identify and to stay in the trend. So that was great.
Beautiful. That's awesome.
All right.
And also the decline that preceded it. Studied that distribution top and the decline that occurred in the series of climaxes occurred into the low, because that's a fabulous case study also. And you can see here, and this is the point I think I was wanting to make, that how this distribution could be like Apple, is that notice how the shortening thrust as it was pushing up to its final high, and then you can draw some very clear uptrend channels and overhanging supply lines, and you want to draw those, go in and get in there close and draw those trend channels. And you can see how once this thing was distributed, and a lot of distribution occurred on the way up, that once it turned, it came down very similarly to the way Apple came down. And so you might want to look at those and see how they're distributing these shares. So on a scale up, and this is what Icahn did. He sold shares on a scale up to take that 1/2 tranche profit on his position. And so that gives you an idea how they're selling shares in rising trends. So there's a big clue there about what's going on. So that's really what I wanted to say about Netflix, and that it's just a great one to study.
Mm-hmm. Okay.
It's going to be an important case study in the future for us.
Yeah, I think it is a great case study. And let's just see if during the Q&A session we might have some questions about Netflix.
Okay. So let's do some questions and then
Okay.
let everybody have.
Yeah, before we go into questions, I just want to really quickly talk about the products that we have for you guys. And so that you would be aware of if you'd like to expand your knowledge or obtain more of the skills for using the Wyckoff method, these are the products that are available to you. The next class at San Francisco campus is going to be FI355 class. This is a continuation, the second class that Bruce and Hank Pruden are going to teach at San Francisco campus. It's going to start January 5th, go to March 1st, 8 sessions. It's only on Saturdays from 9 to 2 p.m. officially, but I think, Bruce, you usually end the class right around 1.
The last hour we break bread and continue with
at the restaurant.
Yeah. Right. By the way, I expect that my expectation is I'm going to be able to make most of those classes. It's sort of a weather thing for me, but we are going to focus on 2 things: point and figure, horizontal point and figure counting methods, which are very important, and I'm going to reveal some techniques that I've developed that I think have massively increased precision. And so we'll do some of that, and I think Wyckoff would approve. And then the other part is the art of the campaign. So we're going to add some work on how do you establish, set up, and execute a campaign so that you can literally be in the wake of somebody as skilled as Carl Icahn and follow his trade up and do it, really effectively. And then that course, we're going to we've decided to open it up for people that are maybe not Wyckoffans but have significant knowledge, market knowledge, and would like to have point and figure counting in their tool bag. And so, according to Hank, so you need to just talk to Hank and get approval from him to take the class. But it's going to be, I think it's going to be a very really fun class.
All right. Campaign is something that I for sure would be extremely interested in, to hear you and Hank to talk about, because again, as traders, and first we kind of become analysts first and then traders. So we always consistently looking for that point of entry, and I see a lot of people just disregarding the exit, or how do you actually follow the trend. So the campaigning, specific trades, setups, will allow you to create even the mental capacity to stay with the trend, not just to enter it. So very important subject there. All right. So the second offering at GGU that we have is the cyber class. In this one is a FI354 class. This is the first Wyckoff class in the series. So for those of you who are becoming the Wyckoffian students, are interested in starting your studies, this is an excellent opportunity to start. And I will be teaching this class. There are 15 weeks. 10 of those are going to be online webinar sessions. And if you have any questions about either of the classes, either contact Bruce, myself, or Professor Pruden. In November, December, I would like to conduct 5 sessions on supply and demand. This is something that we've discussed with the latest advanced Wyckoff course group, but we haven't done this with the first and the second group. So I just want to bring this material to my alumni and just to go through this, because the material is appropriate for all levels. If somebody in this group would like to participate, just email me and I'll give you more information. And the last offering that we have is the Advanced Wyckoff course, which is a one-year course that I conduct online. We have quite a few students, alumni, and the present students of this course. And basically it covers everything Wyckoff related, and we just make it very, very practical. So we take all of the theoretical concepts and we try to develop the skill in application of those principles and methods. And it's been, I think this is the 5th or the 6th cycles that we're going to start. So the course has been quite successful, and I hear from the students that you know, they are making really, really good money applying Wyckoff methodology at the professional level and at the individual level. So if you have any desire to be enrolled in this course, please let me know. All right, I think that we're going to open the Q&A session.
Sure,
So,
let's do a few Q&A, and we apologize for going on so long.
yeah, well, I kind of knew that that's probably what's going to happen. So we're doing okay.
So we can do questions. Either you can I guess ask them, or you can type them. I saw something from David, and so David's asking if this is going to be recorded and available for review.
Yes, I am recording this, so David, I'll make sure that everybody in this group will have an access. And Bruce, I don't think that this is going to be a problem, right? Because we want to post this, by the way, hopefully on YouTube, just for other people to see this particular session and just to bring more awareness to Wyckoff methodology. So it will be available.
Okay, so other questions?
Okay, so a question from Peter. Peter is asking, why would a composite operator bother with a redistribution? Why not take it all the way up? So I'm thinking all the way down, you know, in the.
Oh, I see. Okay.
So
go ahead.
Go ahead.
So the idea of why would the composite operators, so the idea is that they go from long to flat to short.
Mm-hmm.
And so, which is not always the case, by the way. Oftentimes a CO will distribute their shares very successfully in a distribution area, maybe even on a scale down. The old saying is that the large interests would wait for the final peak to be put in and then sell shares on a scale down off the top, because there's a tremendous amount of buying interest by the public on that. So there's really maybe two parts to the question. One is are they short? Why would they bother with redistribution? I guess the answer that comes to mind for me is that on a redistribution level, it's an opportunity to either get short for the first time for somebody who's inclined to get short, or it's an opportunity to add to a successful short campaign to add additional shares in the pause. So hopefully that answers the question.
Mm-hmm. Okay. Another point here that could be made is with the distribution ranges, it's also important to see where the supply comes. I always want to see where is my supply, where is that highest point, where is the first point where I see that clear evidence of supply. And sometimes you know, we have the flat formation, and then supply comes more in phase D, which is more evident. And sometimes it comes in phase A, and we have a distribution where there is an attempt to go up and to redistribute the stock at the slightly higher level. So composite operator also wants to get out at the best price, but he also, bound with the capacity to distribute the stock very easily. So the distribution can come on the first leg down, and then the composite operator would just leave the stock, and that will create the rally, or even buy into the stock and buy some position with the intention to redistribute the stock at the slightly higher level. So, and that could be also an intention. All right, Scott is asking, can you address structure in multiple time frames, daily and weekly? And Scott, why don't you unmute yourself and just maybe rephrase this question so that we would have a better understanding of what you want to hear.
Sure, guys. Good evening. Great work. I just wanted to get some clarification on the use of of labeling the Wyckoff points in daily versus weekly, advantages or disadvantages. I often find it's helpful to zoom out to try to see some of the larger structures and then get comfortable with that, and then kind of zoom in, into the zones where we may be seeing a phase C, possible phase C, and then go forward from there. Is there any nuance? Is there any nuance necessarily in our advantage in using multiple time frames?
I tend to do the same thing that you do, and I like to look at the weekly. I spend a lot of time looking at weekly data, and then going into, so for instance here, I think that are we looking at weekly data?
It's the daily. Okay, let me switch to weekly.
Oh, is it daily? Oh, no, it doesn't. It's okay. So the weekly data you can see the larger sort of story or structure, and the thing is, when you're in a campaign, a worthwhile campaign in my mind is one that shows up on weekly data.
Mm-hmm.
It shows up weekly bars, weekly volume. And then from there you go into the daily data and into the daily vertical bars. And so let's go daily here, Ramon.
Mm-hmm.
And then what you would look for, and so I'm going to just zoom on an example. So here we have in October, we have a low. No, I guess it's November. Go back to that early low on the left side of the chart.
Oh, right here?
Yeah, so you have a low. So you know that that low is going to be important later on if this is accumulation. So then you come down and look at how it gaps down through that low in July. So you can see that really well in the daily chart. And you look at gaps as forms of climactic behavior. So this is a climax in a very small way inside of a much larger structure. And then you have a series of, you have a low, and you have a test, and you have a test. And then you have this beautiful rally in October where you have these big wide bars and you have good volume, and you go, wow, this is characteristically different. And then you get your test and look at the little gap inside that one day where they go sideways and they put in a gap and the volume comes in, but that gap is like a little climactic type action on a daily bar that sets the test. That's the kind of thing that you can see in the daily bars that you can understand within the context of the weekly bars. So you wouldn't ever act on that just on its own, but you would act on it within the context of the much larger structure. So that's the way I think of it. So hopefully that answers your question, but I tend to think the way you do on these things.
That's helpful.
Mm-hmm. Absolutely. Also, look at these guys. My preference, and this is what I tell students, when you look at the historical picture, let's say that you're looking at this picture right here, you want to understand the stock, the history of the stock. And I usually put the weekly charts and just try to see the biggest picture possible, preferably even from the IPO, because I also want to understand what is the velocity that the stock can create. You know, is it a matured stock? How does it move? If it moves to the downside, how quickly can I expect that move to happen? But more to what Bruce was saying, imagine that you are somewhere here or here, and you really, you know, a lot of students are looking at the small trading ranges, which is fine by itself. But it doesn't mean that in the bigger structure the stock is ready to leave the trading range, the bigger trading range. So it might go to the resistance and then still go back for the final test in phase C, right? So if we would look at the bigger structure first, and we would give the definition of where we are in the structure in terms of the phase analysis, this will give us an advantage to open the positions with the intentions of campaigning, with the long-term intentions, where you're entering in a long-term phase C, but you're entering based on the daily charts. This is where your entry is going to go. And for some of us, it's going to be even on the intraday if you have the, you know, tools and capacity to implement the intraday switch to the daily and then to the weekly. And then if you understand your entry both on long-term structure and the short-term structure, the result could be quite beneficial. All right. Any other questions that you guys have? It seems to me that you have to keep watching the stock through it, and by through it I probably assume the trading range. Yes. And Bruce, please tell us, how do you screen the stocks? How do you screen for those structures?
Well, a lot of it is just looking at endless numbers of charts, and then what happens is that you identify stocks that you really want to campaign, and of course that's what we're going to cover next semester is you know, how can you identify among 10 stocks and find the 3 that are really the best to campaign. But one thing that I do is myself and a couple of others, we have developed sort of a trend determination system that helps us to identify when we're sort of getting into that CD phase. And so we can sort of have that system go out and look at the whole market and help us to see, you know, what's leading and, you know, what's getting ready to show leadership. And so it's sort of a little trend model, and that's very helpful. But still, to me, it just comes right down to, you know, okay, looking at that trend channel, and then trying to tell a story about accumulation in there, and then seeing a big count, a worthwhile count, and then seeing leadership and seeing it starting to act better than the market, and then just going, I got to own this, and then hanging on for as long as it continues to demonstrate those qualities.
Mm-hmm.
So.
All right, and David also gives us a comment here. The entire life cycle, and wait for months or years until the right moment comes to buy the stock. So I think that we are blessed and cursed in the way that we have so many choices in stock market. I mean, we literally have over 7,000 instruments that we can look at, and in reality, we just need, I mean, if you're an individual investor, you just need, you know, from 3 to 5 to 7 stocks. So how do you choose those from such a big universe of stocks? So the curse is large number, and the blessing is that using Wyckoff methodology, you know, you can create the selection filtering mechanisms that will allow you to identify potentially the future, not just of the leading stocks, but super leading stocks, the ones that are going to advance for a long time, and they're going to be the quickest, the biggest. So we can definitely look at the characteristics of those.
One thing that we did in class and is that we talked about rotation, and what tends to happen to industry group rotation is you go from early cycle beneficiaries to mid-cycle to late cycle. And so there's a common tendency that shows up in cycle after cycle, and this goes back, there's a guy named Colonel Ayers back, 100 years ago, 80 years ago, who he did great work and showed it then. And I think it goes back to the beginning of time, where it's the interest sensitive that tend to do well at the beginning of a cycle under leadership, and that would be banks and insurance companies and so on. And then mid-cycle is going to be more industrial, and then late cycle is going to be more inflationary. And if you can just see those rotations, a big part of the characteristic of a bull market is being able to identify the rotations into and out of strong groups that are going from strong to weak and then weak to strong. And so that's a big part of the art of it, and Wyckoff is very attuned to that. So rotation is something that we really want to be aware of.
All right.
In our analysis.
One more question. How should we think about earnings releases? This question is from Peter. I'd imagine that many big moves occur around the earnings, for example, marking beginning or end of a trading range. And Peter is asking, is there any special treatment around earnings announcements that you take? Okay, well, I'm going to jump here.
Yeah, you go ahead.
So one of the things that I did with my professional clients is that we've backtested this Wyckoff signals before the earnings. So we basically looked at the prior trading ranges, identified whether they were accumulation, reaccumulation, distribution, redistribution, and we said, well, we want to look at the earnings that are kind of like a little bit in the future. And 85% of Wyckoff signals actually identified the correct movement of the price after the earnings. So after that study, I actually felt really comfortable going into the earnings if there was a price signal. And if you think about this, the logic here, if it's true accumulation, then the big interests are anticipating that the earnings will produce a positive result. So in this anticipation, they are starting to accumulate the position not right before the earnings, but way, way earlier than the earnings are going to come. It's the anticipation that creates that desire, to accumulate that position, and is being reflected in the price. So we don't have to know what kind of earnings we're going to have. We don't have to think about this. All we have to know is that, yes, the earnings are on the horizon. We have to be have maybe another methodology about our stop loss movements because the volatility is going to increase. But primarily, I've seen that the Wyckoff signals actually is a good measure of prediction for the earnings season. Bruce?
My tendency is to look at a stock or to look at stocks 4 to 6 weeks before earnings. And if it's a stock that is trading based on earnings momentum, or if it's a stock, a lot of times what happens in stepping stone reaccumulations there will be an unexpected slowdown in earnings. And so the stock will go into a pause because of a disappointment. And what will happen is that the stock will get back on track again. Maybe the earnings are still good. The earnings are just have slowed unexpectedly. And so what I'll tend to do is I'll try to find the best Wyckoff entry strategy in a stock that I want to own weeks and weeks and weeks before the earnings. And then what I would like to have happen is that the stock has got a profit in it going into the earnings announcement, so that if I've got my analysis wrong, or even if I have it right and they use the earnings to, say, back it up to the creek, that I'm in a position where I can put protective stops at a break even or maybe even a slight gain. And so my only point is that I like to do that way ahead of time. And so I'm not so much interested in earnings as much as I'm interested in how I think the CO is going to play the earnings. And because I'm not smart enough to be able to figure out whether they're going to be good or bad or whatever. So that's just my tendency.
Absolutely. Okay. Do we have time, do you think, for one more question? Bruce?
Well, I do.
You do? Okay.
If somebody has a true burning question.
Yeah. So we have a question from David. I have been trading on the uptrend of Wendy's, and even though I've bought at the bottom of the trend channel and then the stock goes up to the top and there is a large profit. However, since I'm trading for the long term, the stock goes to the bottom of the channel and all of the profits is lost. It seems that once I've purchased it, I have to stop looking at the chart because my point and figure calculations show that the Wendy's should eventually go up to 12 or possibly 26. My point is that I keep getting potential profit, then losing it while I'm waiting to reach my point and figure target. What is the best way to trade the long term? So I think that the question here, and I can bring up the chart, the question here is, how do you actually trade a long-term structure? So like Wendy's here. So we were actually discussing with this stock during springtime when it was going up already, and we saw the accumulation range here, and that the stock has started to move, the volume started to confirm, and the resistance was very close to be broken. David, why don't you unmute yourself really quickly and just maybe pinpoint the exact question that you want to ask.
Okay. Can you hear me okay?
Yes.
Perfectly.
Okay. So in one sentence, what is the question?
In one sentence?
Yes.
Or two or three.
Or two or three. Okay. Well, as my text stated, I keep seeing profit come and go because it's going up and down, and I got hit by these recent political events.
David, let's just do it a little bit differently.
Yes.
And the reason why I'm trying to extend here more a point of reference is because I know you and we've discussed this stock before, but because we don't have a lot of time, what is the trading issue here? So you are getting into the position based on the you were mentioning the channel, right? So let's give us the exact price and the time where you get into the position.
Oh, let's see. Okay, hold on. Let me get my data here.
So I'm just trying to identify what is
By the way, while David's looking that up, I just want to point out, Roman, look at how well Wendy's follows the B phase type behaviors early after the climax. So it's just big, wide-ranging, just unexpected turns, big moves up, big moves down. So that's all classic B phase behavior, and is a good example of why trading the B phases is really difficult, and how that's very characteristic of a B phase.
Mm-hmm.
And so you can see as you get later in the B phase that you start to take the volatility out of the stock, but it still doesn't mean that the stock isn't going to attempt to go down and return back to the bottoms of its trading range. And look at how long it takes. I mean, it's just a long, grinding drop.
Mm-hmm.
And so this is why B phases are just so difficult.
Mm-hmm. And don't you love those long trading ranges that are just like wearing people off? And then at some point, that's why you have to look at those charts, and you have to look at the weekly charts and the monthly charts as well. Because if you want to participate in the big move, and look at this move, right, already 100%, you have to follow these structures, and you have to understand what Bruce has just described. You know, from the phase of volatility, you go into the phase where the spread, look at the spread, yeah, it's contracting, you know, and then this final retest and see. All right, David, are you ready?
Okay.
So let's be very specific, because we cannot take a lot of the time here. So where was your entry? At what price and what time?
Okay, a couple of my trades in August 26th, I purchased at $7.99, but then it went up. As it went up, it was well, anyway, it was kind of starting to come down really rapidly. So I got to admit, I kind of freaked out. So I sold a little.
Okay, so the purchase was right here, correct?
August 26th.
Let me just.
Yeah, about that.
Yeah, and then you got out on this movement to the downside.
Yeah, I got out at 8:10.
All right. Well, why don't we just look at that, right? So one of the things that I see here is that, well, first of all, probably this move, it shouldn't scare you that much. Why? Because when you look at the demand right here on the way up, you see that it's a very consistent demand. The demand is increasing, so it's a bullish case here. And then your first spread, down spread, comes on this volume spike right here. What you want to do is you want to compare it to the previous reactions. And one of the things that I always say to students, if you want to enter in the reaction of if you enter in position, compare it to the previous reactions in the trend. What are those? And look at the volume signature. What kind of volume you have in those reactions? How does the price react around those reactions? And if you would look at this, you might say that, listen, the volume is actually comparative to what we had before, and the spread is slightly even smaller than the spread in the previous reaction. So it shouldn't become a big concern for this bar. And then look on the increasing bar right here, you have the volume that actually goes even lower here. So supply goes lower. So there was no reason to get out, but one of the mistakes that are possible here is that you're entering at $7.99 and your stop loss is very, very small, so you're just forced to be stopped out. So one of the things here, I think that the mistake might have come even earlier than this, because if you are truly filtering the stocks and you are selecting the stocks, you're already looking at the stock probably in this neighborhood right here. And you might miss the phase C, which is okay. You just have to understand where to buy next. So the next buying opportunity is going to come during this sign of strength, what Wyckoff was saying, calling the price running away from you. And if you have the confirmation of the volume and the spread increasing, this is going to be your point of entry number 2. If you miss that, then you want to look for that back up to the creek after the jump across the creek. So this area right here is your back up to the creek. It is a trading range by itself, so find the place where supply is being observed and look at the supply here. Yes, it's increasing in the comparison with phase C right here, but as the price goes up, there is more participation by professional interest, which will create more volume on the reactions. This is one of the distinctions that we discuss in supply and demand classes. So you have to get used to this, seeing more supply as the price advances, but you have to judge it within the context now of this trading range. And even if you miss this one, then a breakout out of this trading range could be another opportunity to buy. If you miss that one, then you really have to think as a true Wyckoff and wait for the reaction. Because as the price advances, look how quickly it advanced. 1, 2, 3, 4, 5, 6, 7 bars to the upside. So you are buying on such a momentum trade. So your intention either should be really, really short term, where you're just taking the profit really quickly and the momentum still carries you up in this move, or you should wait for the reaction like this and then establish a position there. So that would be my advice. Bruce?
I think I have nothing to add. That was good.
All right. David, have we answered your question?
The only thing I can say, David, is that I've been in the same situations. So it's
yeah, and me too. And I mean, that's how through the mistakes we've developed the understanding of the methodology, and we're trying to bring it to you guys, and we really appreciate that you are here today. I think this is it.
I would only add here, because it's a good example for everybody, is that notice this period really just burn into your Wyckoffian mind's eye this area between, say, 5 1/4 and 6 1/4. That's a backup to the edge of the creek that's on a rising scale. Mm-hmm. And when you see that and go back over to the left side of the accumulation range, and you can see that it's grinding up through these 2 prior peaks right here at this, right there. And the way that it's grinding up through that and making higher highs and higher lows while it's doing it is really, and it shows aggressive buying. And then subsequently the way it comes out of there with such wide bars, ease of movement, good volume, really shows that the stock is been heavily absorbed, and that the stock is in strong hands. So that's a terrific example that you'll want to put on your in your playbook. And you see these all the time. And when you see something like that, you go, I got to take a swing at this stock.
Mm-hmm. All right. Well, I see no questions. Thank you, David. No more questions, so I think that we should stop here, Bruce.
Good. Thank you.
All right,
Good
Bruce.
job, everybody.
Thank you very much to you and everybody else.
I'm glad we were able to keep it under an hour.
Yeah, I know. With you and I, we always do that. Yeah, we just try.
Is it a West Coast hour?
Yeah, I can't imagine people on the East Coast.
I have so much fun doing this with Roman, and I'm a Wyckoff student, and I'm like a little kid, and I love this stuff, and I love hearing. Roman's got such great wisdom about it, and it's always something when Roman was a student of ours in the mid-90s. And it just, when they get to the point where they're just so much smarter than the instructor.
Oh, please, Bruce.
I get a big kick out of that. So anyway.
Well, I always enjoy having sessions with you. Well, thank you. Thank you.
Thank you all.
Yeah, thank you, guys. Yeah, wonderful session.
So.
All right. And the recording will be available, so just let me know.
There was a couple of people that had to come in late. And so what is the process by which they're going to receive the recording?
I most likely, and I know most of the people here, so we're going to post the video in the Dropbox, and I'm going to give you guys the link to that. And then the second thing that I want to do is probably post it on YouTube, and just when I have that, I can also distribute the link.
Terrific. And Ken, will you make sure that I have your correct email? I'm not sure that Ken's still on, but no.
Yeah, I think Ken left.
I'll find it. I'll get it.
All right.
Okay. Thank you all.
Thank you, guys.
Thank you, Ramon.
Thank you, Bruce. Bye-bye.